A year ago, I was asked to speak to the World Exchange Congress in Madrid. And at that time, the whole space was filled with announcements of M&A and big cross-border mergers and planned mergers. Well, none of that really transpired. In fact, I'm sure that a number of people in the audience last year thought that perhaps a year from then, perhaps now, there would be one huge, massive global exchange, and this would be a much more intimate conference. It would be me and talking to one of you, or maybe two of you. I'm glad to see that there are so many more faces in the audience today. So that time has sort of passed. But perhaps some of these headlines have a familiar ring to you. These headlines are from an industry that, too, was state-owned and then privatized. Enjoyed a tremendous amount of competition when they were privatized. Also had a whole bunch of cross-border mergers announced, none of which actually got consummated. So if I told you that these headlines, which were ripped from papers all over the world, have nothing to do with the exchange space, and in fact, I'm not going to even speak about the exchange, well, I am, actually. But these headlines actually refer to the airline industry. So, how many people actually traveled here via plane? Came here via plane? Okay, so this talk will have some relevance to you. You're going to understand the analogies that I'm going to make. And what can we learn from the airline industry? Well, in fact, it has so many similarities to the exchange space, except that the airline industry went through what we're going through 20 years ago. So we have a case study that we can look at that has winners and losers, and the winners we can look at, and we can actually extract some of the winning strategies and take home some of those strategies with us. And what I tried to do was boil it down into just simple 3 Ds. Let's keep it simple. The first one is diversification of revenue. Second one is differentiation of product. And the third one is developing a global strategy. And the metaphors are just tremendous, actually. So let's talk and start with the diversification of revenue. Now, those of you who did travel here via plane understand that you got stuck in this tin can. And what the airlines started to understand is that you're trapped. There's no way you can escape from the time the door closes to the time that you get to the ultimate destination. What can they possibly sell to you? So, how many people here have actually bought anything from Sky Mall or from Duty Free? Oh, come on, really? I'm the only one. So if you're anything like me, for some reason, every time I go to a sunny place, I forget my sunglasses. I can't tell you how many pairs of sunglasses I bought from an airline, right? So they don't fit all that well. Actually, they're very good. But it's just an example of, when you call up and try to make a reservation, well, now they're going to try to sell you a rental car and some hotel room. But you know that you get on the airline, and you sit down, and you can buy premium liquor, you can shop for your kids and your spouse, and you can plan for your next vacation, all on the way to your ultimate destination. That is a captive audience. That's selling more to your customers who have already bought from you. So there are some examples and strategies that we can learn from some of the exchanges that have been through this longer than anybody else, experienced competition longer than anybody else. It's New York Stock Exchange and NASDAQ. So the New York Stock Exchange and NASDAQ also recognized that they too have a captive audience, a whole customer base that have already entrusted themselves to their brands. What else can we sell to those captive customers? And historically, selling to those companies that list on your exchanges has not been a primary strategy for the exchanges. The 3 primary sources of revenue for an exchange, as you all well know, are transactions and listing fees and data services. And certainly, there are lots more ways that you can diversify revenue. You can go both horizontal and vertical. I mean, you can expand into different asset classes, as you are doing. And you can get deeper penetration into your existing customers. So you take a look at an example of NASDAQ's diversifications. And what they did was they bought up some technology firms. They packaged them together. They created new services that they can provide to their existing customers. And if you take a look at really a well-done example of diversification, take a look at all the different lines of business that NASDAQ has today, and not one of their revenue streams accounts for more than 20% of their total revenue. That's a job well done, I would say. Let's go to differentiation of service. So it's interesting, and this is another great parallel, that most of the competition that came in from the airlines came in at the very low end. Right? These non-unionized shops that came in and undercut the incumbents' prices and really totally commoditized the coach section of the plane. So what did the airlines do? They created a whole premium service offering to a premium customer. So, they expanded first class and business class. They made the seats much nicer. They upgraded the lounges. And for those people who are paying for their meals in coach and their pillows and the extra baggage, think about the class of service that you get when you're sipping champagne and eating steak and gladly paying another $500 for that privilege, right? To be treated special. Well, the airlines get most of their revenue and most of their margin from the premium service that they offer today, not from the commoditized section. So what are the premium services that exchanges can create? And who's the premium customer that the exchanges can go after? And where is the margin? Who are the folks that are ready, willing, and able to pay to be treated special? And to me, there's a whole constituency out there that has not been served at all by virtually any exchange around the globe, and that is the asset manager himself. Asset management, the assets under management have grown 40 times in the last 30 years, yet nobody's catering to that class of customer. These are people that have gazillions of dollars and are willing to pay extra to feel special, to be treated special, to be separated by a very thick curtain from the coach class, right? And what is the problem that we have to solve? What's the service that we can offer to these premium customers? Well, what do they need? These people need a different class of service. They need greater liquidity. They need a larger average execution size. They need tools that are specific for an institutional investor. They need anonymity. They need tools that are separate and apart from those tools that you provide to your coach class customers, to high-frequency traders and the low-cost providers. And they need that thick curtain. You know that when you're in first class or business class, those guys sitting in coach can't even use your lavatory. And there's something nice about that, I have to say, when I sit in first class or business class. That analogy has to stay with the exchange space too, in that you have to provide that curtain for the premium customers so that it has to be up to them to decide whether and when to interact with the folks in coach, the high frequency, and whether and when they want to interact just among themselves. That's a service that they really need. And in fact, as Robert said, this is something that we have introduced, right? No? Oh, let's go to the next one, and that is developing a global service. So the airlines, if you think about all of their announced mergers and acquisitions then, and the fact that none of them got done, but it wasn't even realistic to think that an airline could acquire enough other airlines to create a truly global product. But what is the problem that we have to solve? Well, there's a customer that wants to board in Anchorage and ultimately arrive in Istanbul. And, the airline doesn't service from Anchorage to Istanbul. So what did they do? And in fact, we all know they created airline alliances, which was, in fact, much cheaper, much faster, and just a technology integration issue, and not a regulatory issue, and not a huge financial commitment. But if you think about this code sharing, and this is still relatively recent, so that a customer in Anchorage can board with one ticket, check the luggage, and no matter how many different airlines they have to get onto to ultimately make it to Istanbul, there is a somewhat reasonable expectation today that the luggage will arrive at about the same time that the passenger does, at the same location. So that's a beautiful thing. That's a global and a seamless service that airlines can now provide without owning the entire supply chain. So what can exchanges do? Well, first of all, let's recognize that consolidation in this industry is dead as well. And it was just as unrealistic to think that any exchange can consolidate or acquire enough exchanges around the world to have a truly global offering. So what's the problem that we have to solve? And what's the service? What's the offering that exchanges can gather from this analogy? And that is, well, the world is a much smaller place today. Exchanges historically have lived within their own confines of their borders. But you know that your customers and your customer's customer now want to be able to invest in the best opportunities wherever they're located around the world. And your opportunity is to be at the center of that, be that airline alliance and offer that, be the portal to the rest of the world. And just as important, investors all over the rest of the world would like to invest in the best opportunities, and I'm sure a lot of them reside in the companies that list on your exchanges. Why not be the center of that as well and offer that kind of capability, a safe and efficient means to acquire more of those institutionally invested assets and gather them into your country? That's your opportunity. And in fact, what we've done is we have, as Robert said, formed a partnership with the 6 Swiss Stock Exchange. I just want to do a little shout out to the 6 Swiss Exchange for having, and Kristen Katz for having the forethought and the vision to actually create a whole new market structure out there, not to acquire everything, but to partner and to ally. And so Liquidnet is the network of 630 of the largest asset managers around the world, and collectively they manage about $13 trillion of assets under management, equity assets under management. That's an enormous opportunity. So what we did was there's an enormous amount of Swiss liquidity out in the world, not on the Swiss exchange, managed by our customers around the world. And so we bring that massive amount of liquidity back to the Swiss Stock Exchange, which in and of itself is a competitive differentiator to any new low-cost entrant that might want to come in and compete with them. And when we combine our liquidity with that found on the Swiss Stock Exchange, we expand the liquidity base. We make a more efficient market for investors around the world to be able to invest in the Swiss market. And it's very, very early days. I mean, last year we just announced it. We went live in the summer. But already, the average execution size of that service is more than 60 times that found on the exchange. Another huge differentiating factor against anybody from the low end that wants to come and compete, because they simply cannot do that. They cannot replicate it. And by bringing more liquidity to the exchange, liquidity begets liquidity. And that, too, expands the opportunity for the Swiss Stock Exchange. So I know, since most of you came here by plane, you all are going to get back on those, those steel tubes, captive audience sitting in your seats, and think about the different ways that airlines have actually deployed their strategies and what you can take away from it. So when you sit down in that seat, and for all of you who will have forgotten to buy your spouse or your kids something while you were in Istanbul, and you peruse that SkyMall catalog, think about all the different things that you can buy on the way home that you can say you bought in Istanbul, but you really didn't. For those of you who are sitting up in the first class in the business class cabin, sipping your champagne and eating your steak, think about how happy you are that, in fact, there is a premium class service, and how happy you are that your company, or in fact yourselves, paid for that privilege to have that steak and that champagne. And think about, if you have multiple hops to get to your final destination, how seamless that global alliance has become, and how easy it's been for you to actually go from, if you are going from Istanbul to Anchorage or wherever your final destination is. And hopefully that's given you a little bit of food for thought for the next few days of this conference, trying to keep it simple. But this is about strategies that are already deployed outside in the real world that you could take back and think about deploying when you get home. So I'm going to be around for the next couple of days, and if you want to talk, just grab me. But in the meantime, I think I probably have a few minutes for questions, is that right? Okay. So I'm happy to take any questions if you have.
Peter Randall from Aqueduct. Seth, hi, good morning.
Hi, how are you?
Hey, good,
nice to see you.
Good, thank you. I think it's also the case, is it not, that if you add up the total amount of money that the airlines have cost over the years and the total amount of profits that they've ever made over the years, that actually comes to a negative number.
Terrible industry, that's correct.
It's a dreadful industry.
Every single one of those airlines that are winners in the United States have gone through bankruptcy. Let's not replicate that. I left that analogy out. Okay.
Well, I don't know whether JetBlue is the same as some of the challenges. But now, my point was that actually there are some examples, are there not, of companies that have been able to go through your 3 tests. And in a sense, one of them, Apple, has been able to differentiate itself by differentiating its product and by just superior design. Now, is it not the case that there are processes within the exchange space, do you think, that where people can offer superior design?
Look, I think that there's always the opportunity to do that, but the fact is that there's only one Apple. And there's one creative genius behind that, quite frankly, who unfortunately has passed away. We'll see how well that innovative strategy progresses, although I'm sure that they have enough in the pipeline. I really don't like to hang my hat on the success of 1 in 10,000, levels of possibility, but rather to take a look at other more mundane industries that at least the exchange space does not have to rely on fuel or gasoline as a metric of whether they're going to be profitable or not, but to take a look at some tried and true strategies that everyone can actually implement. Apple is just way up here. It's a level that we all aspire to and someday hope to be, but like the level of the probability of becoming that movie stars is so low. So yes, definitely aspire to it. It's just I don't know what the equivalent of the iPad would be in the exchange space. If you do, I will back you 1,000%.
It's Robert Barnes from UBS.
Yes, Robert, yes. We've met.
Seth, it's a remarkable case study of a market so developed like Switzerland that's a source of international order flow, a very well-respected stock exchange, a great endorsement of this new internationalization partnership that you've done with Liquidnet. Do you see this as a model that can appear in other markets? Are you having discussions with other exchanges, and do you think this internationalization strategy is something we should all explore further? Thank you.
That's a great question. First of all, every company, every exchange has to create a global strategy. I think that's clear, right? What that is going to really, it's going to differ market by market. But I think it's pretty clear to say, and I know that there are going to be panel discussions on this later on, but when I say the consolidation phase in the exchange industry, that phase is dead, I think it's really true. Right? I mean, we've seen it. How many more slaps in the face do we have to get from regulators? And there's a really valid reason to reject these mergers. But looking only inside your borders for growth, especially in this time of massive change after the great financial crisis, is just not a good, sound strategy. Part of the reasons why exchanges were developed and created in the first place was capital formation. Right? And capital formation, when they were started, really revolved around, how far the horse and buggies took them, right? But now it's a one global world. To look beyond your borders, to look for capital to come into your country, it's a requirement, it's a necessity. So it's not going to be done through mergers and acquisitions, so it's got to be some other methodology. I don't know any other method, quite frankly, other than the market structure that we created with the Swiss Stock Exchange. It's a great opportunity because it creates that premium brand of service and it caters to a whole new constituency and it serves the purpose that the exchange was originally created for. So that's the best that I have to offer. I'm sure that other folks have other ideas, but certainly it's a great model, and certainly we're speaking with many exchanges around the world, and there will be more opportunities and announcements this year.
Mustafa Baltacı from Istanbul Stock Exchange. One of the important points, I think, in terms of diversifying, differentiating, and developing your markets and your product pool is to have a right tone and right balance of relationship with the regulators and the decision makers. I think one of the important points we can derive from your presentation is this. What does your impression and experience tell about this?
I think that you have to go back to, as long as you, and every regulator is different, but as long as you continue to serve the core reasons for the exchanges being, the reason why exchanges were started, I think that the regulators are going to have an easier time giving you permission to do what you need to do. There's been, and I'm not saying anything that you guys don't know, but when you were a mutual, when you were owned by the state itself, the master that you had to serve were really the members of the exchange and the companies that listed on your exchange. When you demutualized and you became a for-profit public entity, and obviously this is a generalization, but the masters changed, and the master became your shareholders, and you had to serve your shareholders. And if you think that provides a very different goal and perspective for a lot of these exchanges, and that's where focusing on the high-frequency traders differs from, I think, your core mission. And that is, high-frequency traders, certainly that's where all the transaction revenue is and today, and the transaction volume. So I'm not saying that you do not cater to that, but what we've seen, and I think what the regulators around the world are demonstrating today as they get more knowledgeable about high frequency, is that it doesn't serve your core purpose at all. It doesn't do anything for capital formation. They're not investing in the companies. They don't even care about the companies that are listed on your exchange. They do not bring more capital into the country. And in fact, from the member surveys that we've had and what the regulators are seeing is that they are, in fact, at opposite ends of the spectrum. They are directly in conflict with the institutional investor. So, I think that they're certainly targeting the high-frequency trading. If you created a separate class of service where you had two sandboxes, two cabins, right, and you served the institutional investor so that you could get more institutional money into your markets, regulators would have no problem with that. If you offered and created services above and beyond what's being found on these other dark pools or these competitors, meaning, price improvement, larger average execution sites, things that are ultimately good for the market structure itself, those are things that they're not going to have a problem with. They should not have a problem with. That being said, regulators are generally 2 to 3 years behind the changes in market structure, so there's always going to be a conflict there. It's no, walk in the woods for sure.
Yeah, so Olof Neilik from Burgundy. I'm curious with the airline analogy. Why haven't the exchanges been more successful in selling products directly to the fund managers at the top of the food chain? I mean, most of the travel agents are extinct, and you buy the first-class tickets directly from the airline today.
That's the question that hopefully I provoked in people. But think about, we're fairly nascent in this whole privatization and competition stage, right? So, the United States started getting competition in 1996 when the ECNs really started forming. But before that, there was really New York Stock Exchange and NASDAQ. If you wanted to buy a listed stock, you had to go to a specialist on the floor of the exchange. And before then, liquidity was incredibly sticky, right? You could not, it wasn't portable at all. Today, liquidity is very portable. And it wasn't until MiFID came into Europe that there was competition in the exchanges there. So, dealing with a monopoly, a management of a monopoly is very different than managing in a competitive environment. When you start managing a competitive environment, you understand these are generally the very basic rules of engagement, right? So I would say that it's only now that folks are starting to understand, and NASDAQ and New York Stock Exchange, again, being ahead of the curve, have only started dealing with competition. That's the only answer that I've got for you. But you have to do something. And this is a pretty simple way to start, mapping your strategy.
Konstantinos Antoniadis from Begakai. Given the two paths to success that you identified, one is consolidation, the other one is the three Ds. Given that revenue diversification and possibly product differentiation are potentially two drivers of the consolidation, shouldn't one make the conclusion that actually consolidation and the three Ds are not really that far apart?
If consolidation were a strategy that could work, then I would agree with you. The reason why you separate them out is I just don't see consolidation working. The only mergers that have been announced that have gone through are intra-country mergers. Clearly there have been enough mergers that have been announced that are inter-country mergers that have just not been accepted and have not gone through. So, that's a lot of time and an enormous amount of expense. How much was the charge for New York Stock Exchange Deutsche Börse? It was certainly tens of millions of dollars, and at least 6 or 9 months worth of effort. I don't think that that's the best approach going forward or the highest level of success.
I guess on a related matter, if it wasn't for the regulatory obstacles in some of those mergers, do you think that the commercial rationale would actually make sense?
In most of the mergers that were announced, I would say no, right? I can't understand, and I didn't understand what the benefits of London and Toronto, ASX and Singapore. I didn't get it, right? I mean, they're two completely different countries, different time zones, regulatory structures. You're not going to share liquidity. You have very little synergistic benefits. The only merger that I thought was, gangbuster, that I think all of you are very happy that did not go through, was the New York Stock Exchange Deutsche Börse, because they created a cross-border Goliath, right? They were number one in everything that they did, right? Derivatives and equities and clearing and so on. That is a huge opportunity to be a global platform. So, I think that you should all be sleeping a lot better with that merger being denied. Other than that, I just don't see any of the benefits.
Jochen Biedermann, Deutsche Börse. Sid, to what extent do you think your customers, the asset managers, and the classical exchange customers can really sit in a single plane?
I think that curtains are very important, right? So, and I think that metaphor is quite useful. There are different types of investors. And historically, the exchange has had one class of service, right? And you cannot really every investor or every customer requires something a little bit different. Trying to service all of them with the same kinds of tools is just not efficient and not optimal. And that's why you see that there are specialization products coming out, different dark pools handling different types of investor class or offering different types of execution quality. There's no reason that the exchange can't do that. The exchange just never tried. And there is a regulatory component in there because you want everyone to have the same advantages. Well, that's just absurd because there's no other industry on earth that makes the wholesale buy from the retail. Every other industry has created their own wholesale market and retail market. And if you don't do it in this industry, then obviously somebody gets hurt. And ultimately, it's going to be the institutional investor, and the institutional investor manages money on behalf of hundreds of millions of private investors. That's where they put their pension funds and their mutual funds. It's time to start recognizing that that's a massive amount of money and responsibility for a whole new constituency to serve. You can't serve everybody with the same tools. It's not possible. So, yeah, just create the different tools, divide them into different sections, let them play at their own option, but separate them and allow them to be separate when they decide that they want to be separate. And you have the best of all worlds, I think.
So it's more a joint fleet of private jets and classical jets rather than sitting in the same plane?
No. It is the same plane because at times you do want to mix the liquidity, right? You don't want to have separate pools of liquidity, and you don't want to have separate services. There are times when, an institutional investor wants to take advantage of high-frequency, liquidity or whatever liquidity is there from high frequency, and retail and so on. But again, just at their option. They are the premium service, and they should be able to decide when and whether they want to take advantage of it. Separating them out completely, I don't believe is a good strategy at all. Let them all live in the same plane, but just serve these guys steak and champagne.
Seth Merrin.
Thank you.